Hello, thanks for joining us. Today I'm with Simon Barnard and Will Morgan from Smithson Investment Trust. So it's been 5 years since Smithson was launched by the asset manager Fundsmith. Has it performed better or worse than you expected?
Well, as we sit here now in the middle of a bear market, a downturn, it is slightly worse than we'd hoped for at the start. We always hope to generate a double-digit return, which we're still very optimistic about going forward. But at this particular moment in time, where market sentiment is so low, it is a little bit behind our expectations.
So you launched during the bull market for stocks, and initially Smithson's share price did very well. In the last couple of years, it's perhaps a bit more challenging. Does this suggest that your strategy is not an all-weather one, and perhaps, when growth stocks are out of favour, investors will just have to accept that there'll be limited progress from it?
I think it does suggest that. I think we've always been clear that our strategy is one that is based upon maximising long-term shareholder returns, and we've never pretended that that will work in every single market environment. And indeed, we would be wary of any strategy that claimed to be able to adapt to every single shifting market environment. So it's disappointing that we've been through a tough patch in the last year or so, but I don't think that changes our mind about the efficacy of the strategy over the long term.
In the early days of investment trust, you seem happy to pay a high multiple to own a company that had quality characteristics. I'm all right in saying that in the last couple of years, as interest rates have shot up, you've seen deratings across your portfolio. And in that context, has the broader market derating sort of made you pay a lot more attention to valuations?
I don't think we pay any more attention. We've always been focused on valuation. It's part of our mantra. We want to buy good companies at good valuations and then try to do nothing. But the other thing I'd say is we were never happy to pay high multiples for anything. We would love to find great companies at low multiples, but certainly back in the bull market of 2019, 2020 in parts, and 2021, there simply was no choice. I mean, we found reasonable opportunities, reasonable valuations for very high quality companies. Now we're seeing great companies at very, very attractive valuations. So it's, again, a different market environment, but we certainly weren't happy about it before necessarily, and it hasn't changed in terms of our process now.
Smithson was launched as a way of accessing small and medium-sized companies using the proven Fundsmith investment process. 5 years on, has the Smithson approach evolved, and have you found yourself making decisions that actually Terry Smith on the main Fundsmith fund would never do?
No, we'd never make decisions that Terry Smith would never make. I mean, this is an identical copy of the Fundsmith strategy just for small and mid-cap stocks. And also bear in mind that Terry Smith is the Chief Investment Officer of Fundsmith overall. So we report to him in that capacity. And in that capacity, he controls the long list, or what we call our investable universe. So that's the list of about 90 companies now that we have found throughout the world in the small and mid-cap space that we feel are good enough to potentially own one day. And we request his permission to add new companies to those once we've done the research on those companies. So that is his way of safeguarding the long list that we choose from. But day-to-day portfolio decisions are made by us. But no, I don't think we would ever make decisions that he wouldn't make.
Has there ever been any examples of actually you found a company and you've put forward for potential to inclusion in the portfolio, and actually Terry Smith has said, no, this is not something that you should go ahead with?
To tease out a couple of things there have been situations where we've put forward a company to go into our long list, our investable universe, and we have done a lot of work on the company and ourselves felt perhaps this is on the borderline of being good enough, and Terry has confirmed our view, I don't think it is good enough. So there have been certainly occasions where we've put forward companies to Terry and he said this is not good enough to go in the investable universe, but it was never one that we were pounding the table, as they say, over it. Day to day, we make the final decision on the portfolio. So we do often run our thoughts by Terry. We're thinking about doing this in a portfolio, we're thinking about selling that, and he'll give us his views. But there's never been a situation where he said, don't do that.
Since Smithson launched, you've achieved a 38% net asset value growth, but that compares with 57% from the Fundsmith equity fund. Smaller companies have actually historically outperformed larger companies over the long term. So are you surprised that you've lagged the Big Brother fund?
I think, first of all, we would expect, as you say, over the long run for smaller companies to perform better than larger ones. But also, and this is important, with probably higher levels of volatility on a short-term basis. And I think what we've seen, if we look over the period we've been running the fund for, over that period, the MSCI World Small and Mid-Cap Index, which is the reference index for our fund, has underperformed the MSCI World Large Cap by in and around 30%. So in a way, our gap to the main fund is smaller than that. But I think it's been a very tough period for small and mid-cap companies. In fact, if you look at the sort of sell-off relative to large cap, it's now, at, well, the drawdown that it's had, i.e. the level of sell-off is as big as it was in the financial crisis, during COVID, is pretty much the largest sell down that we've had this century. So it's been an out of favor asset class, but over the long run, we still maintain that this actually has good growth potential. And as Simon mentioned earlier, this kind of environment is leading us to see quite a lot of opportunities in terms of valuation of our companies for long-term investment.
Fundsmith's mantra is buy good companies, don't overpay and do nothing. But actually, Smithson's turnover in 2022 was 49%. Now, is that you taking profit in stocks, getting things wrong, or readjusting the portfolio because of the different market backdrop?
I mean, that turnover is certainly the highest one we've ever had. And though when you look over our admittedly somewhat limited history, you tend to see that in years of higher volatility, turnover is higher. And the simple reason for that is because we see opportunity in those market environments, and therefore we want to do something to take advantage of that opportunity.
And also bear in mind that while that is the highest turnover we've ever had at 49%, the average active manager in the market average is 60% turnover or more. So actually our highest ever turnover is still lower than the average market turnover for active managers.
Yeah. So in your opinion, what makes Smithson different to all the other investment trusts?
Well, as far as we're aware, there is no other investment trust that invests in high quality growth, small and mid cap, globally, most are regional, and also in such a concentrated and disciplined fashion. And what that concentration gives you is that we are only able to buy the very best companies at the best opportunities because we have such little space to do so. And particularly in the current environment where we're seeing such fantastic opportunities, it makes us extremely optimistic for the next few years.
So Simon and Will, thank you very much for joining us, and thank you for watching.